Hi, this is McLean Bankley with Archer Trading. Today we're going to go over one of our trade setups here, which is based on the Kelipe trade. If you're unfamiliar with the Kelipe trade, it is basically a setup where you look for penetration of the Bollinger Bands by price and a linear regression indicator. Due to the fact that we use range bars, that is, each bar represents a predefined range rather than a time interval, penetration of the bands by either price or the linear regression indicator is usually quite minimal or non-existent. So we've devised a different way to show the Kelipe trade. If you're a follower of the blog, you've probably seen this trade setup posted many times. However, I'm not always sure that my charts are clear. They make sense to me, but for somebody who doesn't understand the trade, they might be a little vague. So I'm making this video to go ahead and show just how we take this trade. First, we'll go over the chart setup here. We have two EMAs set at 13 and 62. These define the trend as far as we're concerned. So, obviously a moving average crossover up, an uptrend, moving average crossover down, downtrend, and sorry about that. I'm apparently having internet issues here. But anyway, so in the traditional Kelipe trade, we would have a linear regression indicator here. We would look for the linear regression indicator to penetrate the Bollinger Bands either to the upside or the downside. In an uptrend, we'll always look for the linear regression to penetrate the bottom band because we'll only be taking long trades. And in a downtrend, we'll be looking for the linear regression to penetrate the top band because we'll only be looking for short trades. This is a recent trade that we just took. You can see here we have a crossover up. So we'll only be looking for long trades. So the way that I actually show the Kelipe trade, you see there's no linear regression indicator up here. There is, as a substitute, we have taken a 3-period RSI here at the bottom of the chart and wrapped a set of 10-period 1 standard deviation Bollinger Bands around it. So this is where we're going to look for the penetration. As you can see here at, actually close below it, at 1310 GMT plus 1, we had a close below the bottom Bollinger Band. What we're looking for the trade setup is actually to have the price to move, or I'm sorry, the RSI to move back in after it crosses down. We have that at 1426. That is the first condition for the setup. The second condition is here. We have what we call the Stokes slingshot. Basically, it's 3 stochastic oscillators of 3 varying time frames. I'm sorry, time periods. So we have, I think, a 3, an 8, and a 13 period Stoke here. And as price moves in one direction rapidly, the Stokes kind of deviate from each other, and this gives us a slingshot effect. As the greater the deviation, the more they'll snap back. So this is our second condition, and you can see here it's highlighted in green. We have the longer Stokes on top and the shorter Stokes on bottom, and as the shorter Stokes move away, we get that deviation that we're looking for. The third condition would be price would have to be in the bottom half of the Bollinger Bands. The closer to the bottom, the better. And the last condition would be we get 1 bar closing in the direction of our trade. So our entry was actually here at 62.84 roughly. And our target is always the opposite side of the Bollinger Bands. This would have been good for about 35 pips. But as the R1 was moving right up close enough to the bands, we went ahead and targeted the R1, which is a good thing because we ended up getting somewhat of a rejection, 12 pips right now, but price is kind of stalled out. So we took our profits here, and I believe the trade was good for about 22, 23 pips. And it says 31 here, but spreads on both sides, so I think we ended up getting about 23 or 25 pips out of it. That's about it for the trade. We make quite a few of these a day. The simple trade plan for this is we take off half of the trade in 10 pips. You can see we got that here somewhere. What time was that? We entered the trade about 1420, 1430. And sometime between 1430 and 1436, we got our 10 pips. We move 10 pips, after the 10 pips, we move our stops to break even. And our target is generally the opposite side of the Bollinger Bands, or in this case, you see the R1. And that's where we took off the second half of the trade. Again, the target is usually the opposite side of the Bollinger Bands if there's no obvious resistance in that area, but as you can see, at 1300 we had a decent rejection at the R1, so we went ahead and played it safe and took our profits here. They're probably only good for 2 or 3 more pips at that point for the Bollinger Bands, but why risk leaving more pips on the table versus taking them off and making profits. But anyway, that's about it. Feel free to comment. Let me know what you think of the trade. Let me know if you have any questions about it. I'll be glad to answer and possibly make another video if I've missed something this one. Thanks, and have a great day.